Hey everybody, so in this video I wanted to talk about Qualcomm because they recently reported earnings. It wasn't all that great and the stock is getting demolished. So if I'm looking at this right now, Qualcomm shares are trading at 103.62, and if I'm just looking at this at the 10-year one-day time frame, there is this massive head and shoulders going on, and within this massive head and shoulders structure, there's a mini head and shoulders right there. So as of now, we're seeing strong momentum to the downside. The RSI is very, very oversold. It's at 26.5. So that is a super oversold reading. Now, it's been here before, but very few times, far and few. So if we're looking at the MACD as well also looks like shit. So right now, we do have these anchored VWAPs. This anchored VWAP is coming from the COVID low, and this one is coming from the all-time high. And these kind of converge right around this 131 handle. So that is above the 200-day moving average, which is right at 123.46. And if we're looking at this 50-day moving average right here, it's right around 118.16. So we also do have this little gap that we recently created. So if we were to fill that gap, that's right around 112-ish. But as you guys can see, we're below that right now. So obviously, if we do fill that gap and we do get ahead, then yeah, there's that 50-day moving average that's going to act as resistance. Now, if we're looking at the fib levels right here, so let's just go ahead and look at these fib levels. So if we're looking at these fibs, down below here, there is support right at 87. And right above, there's resistance right at 109.79. But take a look right here. There's this old gap from way back when that we could essentially fill. So it seemed like back in 2022 when we made these lows, this was, I believe it was right around Q4 of 2022. We essentially fell all the way down here. We made these lows, and we're right back at these lows. So are we going to fill this gap this time around? And if we do fill this gap, it's going to get filled at 93.60. So that's right around where it gets filled. But like I said, right below that, there's that 87 fib level. So that could act as support if we do break below that gap. Now, like I said, RSI is very, very oversold. So in the near term, I expect maybe some consolidation or maybe just a small rally up. So I do expect some sort of rebound because right now we are very, very oversold. If we were to fill this gap, then I think it could happen in a later date when some of this RSI oversoldness starts getting, basically just starts getting back to neutral. So, as of right now, chart looks very bearish. Let's go ahead. Let's talk about the earnings. So if I just go over here, and right here I am on Qualcomm's investor relations page, I can basically look at the historical financial results, and I could pull up all sorts of data right here. So the most recent was this Q2 earnings, and this is for the quarter that ended March 26th. So it's Q1 right here. And this came out not too long ago. So let's go ahead, let's look at it. So if I'm just scrolling at the top right here, they give us the key information right here. So it says revenues of 9.3 billion, GAAP earnings per share of $1.52. Now let's just scroll down, let's look for the juicy details. So right here, they give us this awesome little table right here. So it says revenues, so 9.275 billion. But what is that comparing to? It's comparing to last year's Q2, which was 11.16 billion. Now, this is a pretty substantial downside. So this is a 17% year-over-year change for the same quarter. So that is not good, and that's a change to the downside. Now, if we're looking at net income, it's 1.7 billion versus 2.9 billion. So this is a 42% haircut versus the same quarter last year. Diluted earnings per share, we took a 41% haircut right here, so it's $1.52 versus $2.57 the prior year. So overall, these metrics, they do not look good. It's clearly showing some sort of deceleration in growth. So that is very clear based off of this report. Now, let's just go down a little bit, and let's look at this right here. So we can clearly see that they're giving us guidance, and the guidance isn't all that great either. So right here, it says revenues of 8.1 billion to 8.9 billion. And just look at the guidance that they're giving us. There is literally a $800 million spread in the revenue. So to me, just as an investor reading this, I'm not really invested in Qualcomm, by the way, but I'm just saying as an investor that's reading this, you would basically say that's a pretty big spread. So that tells me, they have a little bit of uncertainty in how the markets are going to behave. So there's literally an $800 million spread in the revenue based off their guidance right here. So how does this measure up? Well, you want to look at the same quarter last year. So what we want to look at is Q3 of 2022. So if we're just looking right here and we're looking at Q3 of 2022, it says right here that revenues were 10.9 billion. So 10.9 billion versus this range right here. So let's just kind of go ahead and calculate that real quick. So if I were to take let's just give them the high, okay? Or maybe let's give them the midpoint. So let's do 8.4, or what is that? 8.55. Yeah, I think that's 8.55. So 8.55, and let's subtract 10.9. And then we're going to divide that by 10.9. Okay, well, that's about a 21% decline in revenue. So yeah, that's not that great. If we're just looking at what we did right now, let's see, we had a 17% decline in revenue. So now, if I'm taking the mid estimate right here, we're basically saying, hey, you know what? We could have a 21% decline in revenue. And that is the mid. If I were to take the high range or the low range, then yeah, this could go even lower, or maybe, it could be something closer to that 17% that we just had. So as of now, this does not look too good. Now, if we're looking at GAAP diluted earnings per share, this is $1.24 to $1.44. Well, what is that comparing to? So if we're looking right here, that's comparing to $2 or $3.29. So that is a big, big difference, you guys. That's literally over a 50% haircut on diluted earnings per share. So yeah, they gave a bad quarter and they gave bad guidance. So of course the stock is going down. Now, if the stock was going up, then yeah, I would say this is market manipulation, blah, 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 bearish argument, this and that. But yeah, I mean, for once, the earnings actually did, or the stock actually did what the earnings basically told us. So yeah, this is a ray of sunshine to me. Now, if we're going down, let's go ahead. Let's look at the financials. So right before the operating income here, we're going to see the balance sheet. So let's just quickly go over the balance sheet. I'm just going to zoom in a little bit for you guys so you guys can see a little bit more clear. Maybe that was a little bit too much. Nope, it's not. So if we're looking at cash, marketable securities, and accounts receivables, yeah, this is looking pretty good. I mean, that's about 10 billion right there, probably a little bit over 10 billion. So if we're looking at total current assets, that's about 19 billion. And if we're looking at total current liabilities, that's about 7.8 billion. So right here, we have over 2 times the total current liabilities for assets. So that is a pretty good situation to be in. So I'm just looking at the balance sheet, and so far it looks pretty healthy just based off this metric right here. Now, if you didn't know, balance sheets are always organized in terms of liquidity. So in the United States, following GAAP, the most liquid is going to be at the top, followed by the most illiquid. But if you're looking at international financial statements, so if they're following IFRS, then essentially it's going to be the opposite, where the most illiquid is at the top. But like I said, we're following GAAP, so most liquid is going to be at the top. So thus far, it does look pretty good to me. Now let's just go down a little bit. Now, if we're looking at total stockholders' equity, this number is going up. Now, what's also important is if you're looking at total stockholders' equity, you also want to pay attention to shares outstanding. Is shares outstanding going up or is it going down? So if I'm going quickly to the statement of operations and I just look at the shares outstanding, well, the diluted shares outstanding, that is going down versus the prior year. So yeah, that just means that this equity number is looking good. Because think about it this way. You can issue shares to your investors, And that's going to give you cash in return, which is going to bolster up your balance sheet. So if you're seeing shareholders' equity go up and you're also seeing shares outstanding go up, well, then that's not necessarily a good scenario. A good scenario is when you see stockholders' equity go up and you see the shares outstanding either stay the same or go down. That is a good scenario to have. Now, let's just go ahead and go down to the statement of operations. So we already talked about a lot of this, but now they break it down into segments. So we're seeing equipment and services and licensing. So on both fronts, on both of these different revenue segments, we're down year over year. So obviously, in 2022, we did higher. So we did 9.4 billion here, and we did 1.7 billion here. So this is definitely down year over year. Now, if we're looking at total cost and expense, this number is pretty high given the revenue that we're making. So in 2022, we made about 11.16 billion. In that same year, we had costs of about 7.3 billion. So here in 2023, we have $9.275 billion of revenue, but we have $7.185 billion of cost. So this is almost what stagflation looks like in a company. You're seeing revenue growth go down and you're seeing costs go up. So this is not a good situation to be in. So yeah, this pretty much is what stagflation kind of looks like. It's basically how it's structured. In stagflation, you see growth go down, but you see inflation go up. So that's pretty much reflected right here in this company's income statement. Now, let's just go ahead. Let's scroll down a little bit. And yeah, we're going to see that net income and the earnings per share metric, that's down quite a bit. So $2.57 last year versus $1.52 right now. So obviously not too great. We literally had a $1.05 haircut on the earnings per share metric. And if we're looking at the shares outstanding, like I said, it went down slightly. Now we're going to go over to the statement of cash flows. And if we're looking at cash flows right here, one thing that I do like to always look at is share-based compensation expense. So this went up. So it's about 628 million right here versus 497 million in the prior year. So share-based compensation, that is going up. If we're looking at net cash provided by operating activities, that's 1.45 billion versus 2.69 billion in the prior year. And if we're looking at capital expenditures, that's about 453 million, and we subtract these two, and that essentially gives us a free cash flow of about $1 billion versus the last year where we had free cash flow of about let's say like 2.2 billion-ish dollars. So yeah, free cash flow went down quite a bit. Now let's scroll down a little bit more. If we're looking at the financing activity, they paid some long-term debt off. That was about 1.45 billion. So as you guys can see in the last year, they did not have that. So this is more like a one-off expense or more like a one-off repayment that's going to hit their cash account. So obviously, their cash account is likely going to go down. So if we're looking right here, total cash and cash equivalents at the beginning of the period versus at the end of the period, we're looking at about 5.07 billion. And then at the end, we're looking at 3.78 billion. So obviously it went down, and that is primarily because of this repayment of long-term debt. And also, you can see that they repurchased some shares. So they repurchased about 903 million. So this is a little bit less than the prior year, same quarter. But one thing that you also want to look at is look at how much they're repurchasing versus look at how much they're essentially doing in share-based compensation. So they did 628 million in share-based compensation, and they bought back about $903 million worth. So always an important thing to pay attention to. So that basically covers the financial statements right here. Now, one other thing that I do want to look at is if we're going on macro trends right here, we can see a little bit of history. So right over here on macro trends, we can see just the history of their EPS. So if we're looking at earnings per share, we can really see that in this basically third to fourth quarter of 2020, earnings per share just skyrocketed. So here, you're seeing 74 cents, and then it goes up to $2.57. And then we're seeing, multiple $2. So $2 plus, $2 plus, $2 plus. So now, you can see basically from the middle of 2022, you can see that the earnings per share started going down. So now we're in this downtrend. So you want to see, okay, well, where does this actually bottom out? Where does earnings bottom out here? And then you're going to want to see, okay, well, can we recapture, these $3 levels? Because if we can, then this stock is probably grossly undervalued right now. But if you're looking at today's valuation, which I kind of have in the spreadsheet right here. So in the spreadsheet, I have Q1 earnings per share, Q2 earnings per share, Q3 earnings per share estimates, and then I'm estimating what Q4 earnings per share is going to be. So thus far, we have 2 actual quarters, one guidance quarter, and then 1 estimate. So this is just me estimating right here. So, if I'm just being conservative and I'm just taking the low right here, and if I'm just also being conservative for Q4, and Q4 generally they do a little bit better, but I'm just going to be conservative and say that it's going to be similar to Q3, the same lows. So if I'm just looking at 4 quarters of earnings per share, then that essentially gives us the entire 2023 of about $5.98. So this will let me calculate essentially forward price to earnings ratios. So if I'm looking at the key levels that I was talking about in the chart, so if you're looking right here, I'm looking at this fib level, that fib level, and the gap fill zone. So if I'm looking at those levels, if we get to about 109.79, and I'm looking at forward price to earnings, that's going to give us a forward price to earnings of about 18.35. Now, what if we get down to $93.60? Well, that's going to give us a forward PE of about $15.65. What if we get down to $87.10? Well, that's going to give us a forward price to earnings of $14.57. Now, keep in mind that this is the earnings per share for 2023. That could easily change. Let's say that the economy gets better in 2024. Let's say we start doing those $2 earnings per share quarters. Well, then, yeah, the earnings per share for the entire year could be like $8 or something. It could be much, much better if the economy is starting to do a little bit better. So as of now, we are just looking at 2023. And I'm expecting earnings per share to come in somewhere around $5.98. And this is obviously more of a conservative estimate. So if I'm looking back in history, price to earnings is about 12 to 15. So where we're at right now, we're at about 103.62. I wouldn't necessarily say that we're exactly cheap. I would say we're slightly a little bit overvalued, but we're getting there. We're getting there. We're getting to fair valuation here. So let's go back and let's look at macro trends here. So if I'm looking at the historic PE, you can see that it's kind of all over the place, but ultimately, this is ranging from about 12 to 15, like I said. So, what would essentially 12 price to earnings be? Well, if I'm just doing, I would essentially just do 12 times this right here. That would essentially be $71. So at $71.76, I would say, hey, this is pretty cheap. But as of now, I still think it's a little bit expensive, but it's starting to get fair, like I said. Now, another thing that I do want to look at, let's just go back here. Let's look at macro trends, and I want to look at just their revenue history right here. So if we're looking at their historical revenue in, let's see, right here, in 2014, you can see they did about $26.48 billion. But then from here, they started having some decline. So the next year, they had a decline in revenue. The next year, they had a decline, another decline. And then finally, we started seeing some growth. So Qualcomm, it's not a straight shot. It's not like these stupid mega cap stocks that are just constantly growing. They never have a negative year, or so it seems. But Qualcomm, it kind of goes back and forth. So it's just kind of moving alongside here. But as you guys can see, from 2020 to 2021, huge jump. So you want to see, hey, is this actually sustainable here? Is this sustainable? That's a key question. If it's not, then yeah, Qualcomm can still fall a lot. And if it is, then hey, maybe Qualcomm is it's fairly valued right around these levels. So one last thing just to finish it off, let's look at dividends. So Qualcomm's dividend history. If we're just going down a little bit, let's go all the way back down to 2014. So in 2014, you got a 42-cent dividend. And now all the way here in 2023, you got an 80-cent dividend. Just recently, they actually increased it 5 cents. So this is actually a pretty good increase. Now, if we're looking at 2022, earlier in 2022, it was 68 cents. It jumped up to 75 cents. So this dividend is rapidly growing. It's very rapidly growing. And that's very obvious because, look, I mean, if we just look at their revenue and their earnings, their earnings increased substantially. So, of course they're going to start paying out some more dividends because, they're making more money. So to me, it makes sense that, they're giving out higher dividends. But, what happens if they do go into this prolonged growth deceleration pattern? Then, yeah, maybe that dividend might get a little bit more stagnant. Maybe instead of a 5-cent increase, they do like a 2-cent increase or like a 1-cent increase. Or maybe they just don't increase it at all. So that's one thing that you do have to keep in mind. Now, going back to my spreadsheet, I do have the dividend yield incorporated in here. So if we're at 109.79, that would essentially be 2.91% yield. At 93.60, that would be a 3.42% yield. And at 87.10, that would be a 3.67% yield. So obviously, treasuries, maybe your bank account, it's yielding more, but you have to think about price appreciation in the future because, hey, you know what? If Qualcomm does rebound from this, then yeah, their earnings are going to be much higher than $6. We saw that they were able to do over $2 in earnings per share in the past. So if they do get back to that, let's say they get back to 8 times, or they get back to 8 earnings per share, then yeah, I mean, at today's price, it's going to be pretty cheap. So, obviously there's a lot of uncertainty in the economy right now, but what I can tell you is just based off 2023's expectations, it starts getting a little bit cheap when we start getting under $93. So that is kind of when we start getting into the fair valuation zone. So I hope you guys enjoyed this video and have a good one.